Oil has been trading at $90 per barrel for the second day in a row, with the stronger prospects of a potential rally ahead of it. Fuel to the bullish sentiment, both Saudi Arabia and Russia, the two leading oil-producing nations, have extended their oil production cuts in an agreement concluded outside the framework of OPEC+. What's more, the two countries are eager to sell oil for the yuan instead of the US dollar. Yesterday, data from the American Petroleum Institute revealed another reduction in the US crude stockpiles by 5.5 million barrels, making it the fourth consecutive week of decline. This weekly draw largely surpassed analysts' expectations, projecting a modest decrease of just 1.5 million barrels. Yet to continue the rise, oil needs to go through a correction phase. Once the market digests the news, oil prices are likely to retreat to at least $88 per barrel, if not lower, after the deeper news surge is anticipated. Signs are hinting that soon we might be talking about prices reaching the $100 mark. Oil traders are currently disregarding the overbought status of the asset on the daily chart, as the price is steadily hovering above the 90 level, yet the closer look shows reduced buyers' activity around the $91 mark, possibly signaling a deceleration in the current uptrend. At the same time, to start a sell-off of a pullback, oil will need to drop below $89 per barrel. Until then, we might witness fluctuations around the peak of the upward cycle, potentially resulting in a new local high. Meanwhile, gold keeps moving lower towards the level of $1,900 per ounce. In fact, the recent appreciation of gold should be viewed as a short-term correction after a drop below $1,900 per ounce. There was a strong basis to assume that gold would trade flat for a while after this trend. However, the trajectory changed when representatives of the Federal Reserve stated that there were no guarantees that interest rates would remain unchanged in the upcoming meeting. These statements have largely driven the currency market, where the US dollar has been gradually strengthening. In these circumstances, there is a high probability that gold prices might once again fall below $1,900 per ounce in the near future. The bearish trend remains relevant in the market, and holding the price below $1,915 could amplify short positions, targeting the $1,900 level. As for the Russian financial market, the Bank of Russia announced forthcoming currency interventions set to commence at the end of the next week. Not only did the regulator reveal the timeline for these interventions, but it also disclosed the amount of a currency it intends to sell in the market. In contrast, institutions like the Bank of Japan and other central banks in developed countries notify about interventions post factum, fearing speculations that could harm their local currencies. In fact, this move by the Central Bank of Russia has openly invited market participants to drive the ruble's value higher so that they can later sell it at a higher price just before the interventions commence. In other words, the regulator has paved the way for the ruble to depreciate over the coming days. In the meantime, the Russian stock market remains stable, and indications suggest it may soon enter an extended period of stagnation. And that's all for now. We wish you profitable deals. See you on our channel with a new video in a couple of hours.